The service side is not going to improve. Why is that? Why are employees so hard to come by, and you need to pay them more? That's going to be sticky. That's going to be stickier if commodity prices roll over, isn't it?
Yes. So we're going to have the cyclical roll down in commodity prices, also goods prices. But 60% of CPI is services. 30%, half that is essentially housing. 40% of core CPI is housing. And also the wage thing that you importantly point out is going to remain sticky. Employees want a bigger piece of the profit pie to deal with the higher cost of living. So wage gains are going to be persistent. Even if they're going to be below the rate of inflation, employees want to get paid. And you throw in also persistent rent increases, even though the rate of change may slow there, that could be enough to offset any slowdown on the goods side. So the rate of inflation is coming down. But the question is how quickly does it get to that 2% or below level that we were pre-COVID? Or does it settle out at a rate of 3 to 4% that, while much better than we are today, still creates an issue for central banks who still have rates well below that?
Could we, Mohamed El-Erian, what did he used to call multi-speed economies? He loves coming up with like McKinsey words, and then you sound really smart when you say it. But there are multi-speed economies, and let's talk about the euro now, because we could have a much worse slowdown in Europe based on all the mistakes they've made in their energy sort of planning for the future. That could stay tough over there. The winter could be tough. The recession could be worse. Who knows what? I feel bad for people there that this winter, I don't know what's going to happen if it's a bad winter. Could be really nasty. They're going to start using coal again, probably.
They're close to rationing natural gas.
Yeah, they're close to wear a sweater. Wear a sweater. Well, hopefully, hopefully it's not 15 degrees. So I'm not sure we catch quite as bad an economic cold as Europe, and that's what the euro is reflecting.
Right, and that weaker euro just enhances the inflation pressures that they're going to have to deal with, and further pressures the ECB to respond to that. But when you look at S&P 500 revenues, we know about half comes from overseas. So it'll be the big multinationals that are going to get clipped by the slowdown in Europe, and also those that do business in China, because we know they've taken a pretty different approach to COVID. So yeah, no one's immune to that European slowdown. And when you look at the Eurozone, the European region, economically speaking, it's almost as big as the U.S. So you can't be immune to that slowdown there. And to what Mohamed's point about multi-speed, yeah, there'll be some countries and some regions that'll grow faster than others, but no one is going to be immune to a notable slowdown in a large area of the world like Europe.
That is a distinction that we're going to slow down here as well for these global factors, but we can also import some of the worst slowdown that we see in other parts of the world. So we get our own case of, we get a mild case of an economic slowdown, but then, we need to sell into those areas. And China, you're right, China's totally at risk of another COVID shutdown because their entire population, or a lot of their population, hasn't seen the COVID the first time around. Whereas I think Gottlieb always points out, Dr. Scott Gottlieb, we're in a different place than China.
I mean, I can't even imagine running a small business in Shanghai when every day you wake up, you're wondering whether the government's going to close you down, and you got to tell your employees to stay home. And then a week later, you can tell them to come back. And then a week later, you tell them to stay home. I mean, that's no way to run an economy. And there's no traction that is gained from that. And this is the second largest economy. And then that flows through to other economies in the Asian region that feeds into China. And we know Germany, China is their largest trading partner. So it feeds in. It's just all one big cobweb that's all interconnected, that it's going to be hard to separate out different parts to think that they're going to be, again, immune to this.
All right. So you'd be buying dips or selling rallies for equity?
Well, bear markets are a great time to be buying stocks. So whenever you get big dips, you find the stocks that you like from a valuation perspective, I'd be buying them. But value stocks are value for a reason. But I do think we've entered a moment where value stocks are going to well outperform the growthy stuff that still has multiple compression ahead. in addition to the E part that is now going to get hurt.
Wow, it's the most bullish she's ever been in
I was
the last
surprised.
50 years.
I was mouthing
the last
sell
50
rallies
years.
because that was my